Hello and welcome to the paid weekly recap for the week ending March 20th, 2026. I'm Keith Harwood, CIO of Yellow Tunnel, and also pictured as Vlad Karpel, the CEO and founder of Yellow Tunnel, and the creator of the artificial intelligence behind the paid system. Normal disclosures before we get started: options involve substantial risk and are not suitable for all investors. Yellow Tunnel and myself are not investment advisors and not registered with the SEC nor FINRA. The information in this presentation is for education and information purposes only and should not be considered trading advice. And finally, myself and/or the team at Yellow Tunnel may have a financial interest in the securities presented in the trade ideas. I also urge you to read the characteristics and risks of standardized options available at the link highlighted. And if you need more time with the disclosures, go ahead and pause the video here. Otherwise, we'll get into the recap for this past very volatile week. First things first, 10-year yield spiking. Started the week near highs. The 4.3 level was that previous resistance. Highs made in January, early February, rejected, pushed down to 4% as growing economic conditions turned towards the bearish case, and people thought, okay, well, we can lower interest rates. And then we had escalation in Iran, and that started to rally interest rates as the market looked towards the Fed to say, well, I'm likely to see a cut in interest rates when you've got inflation hitting the market the way we've seen in oil and some of the other commodities in particular. And that further became a problem this past week. After an initial fall back to 4.2%, a retest of the previous light resistance, we burst through 4.3% on Friday, getting to 4.4%. Now stagflation becomes a real concern. A situation where we have weakening economic conditions and inflation. The Fed can't cut rates due to inflation, so we cannot help spur economic growth. So what do? The longer things draw out in Iran, the more I think that becomes a concern for this market. Now, the bull may say it's all short term for a long-term benefit, but in the short term, the bear is in control as a result. And we're seeing that in the market. Friday's price action showed that validation, that correlation: higher interest rates, lower market. We tested weakness all week. Monday, Tuesday, things looked like we were getting into that recovery mode as the 10-year yield fell. Everything has that correlation right now. 10-year yield rises, market falls. 10-year yield falls, market rises. So it's worthy of watching the bond market right now. Interest rates are certainly on a lot of global trader minds. We fell below the 200-day moving average. We are in bear-looking territory right now. A lot of long-term trend followers determine long or short the market or long or flat the market by that 200-day moving average. So Friday's breach and hold below was very problematic. Thursday, we tested below, closed right on it. Friday was a very bad signal for this market. Now, can liquidation continue? Possibly. Can we bounce back? Absolutely. We've got a market that is trading within this new bear trend, determining whether the bear trend will work. Because in the past, bear trends have been short-lived and there have been recoveries. But we may hit 600 first. We may hit below 600 first in SPY, below 6,000 for the S&P index. Or this may have been the ultimate low and we start to get the recovery. A lot of this is going to depend on fundamental inputs. If we start to see progress with Iran, I expect to see the market start to recover. And that progress can come from either further decimation of Iranian assets, such as gas and oil fields, and expectations that they will have to surrender, or it could come from actual peaceful negotiation. And I don't know which direction it's going to come from. I don't think anybody does. At this point, we have to wait, watch, and see how things go. Now, the tech market has been reluctant to fall. The tech market continues to test this 590 level, finally breaching it on Thursday and falling through on Friday, but less so than the broad market. Yes, down 1.85% versus the market's down 1.7%, but tech traditionally moves 1.33 to 1.5 times what the broad market's moving. So I expected a little bit more bearishness, absent the fact that tech has really been a consolidation period for the last 6 months. Tech bulls had been rotating out and into things like small caps and industrials. So tech had less fall to happen because the market positioning wasn't aggressively long. Small caps had been building some longs in January in particular. Those fell more. We're not testing the lows of February, finally breaching them. We already did that a few weeks ago. We are still above the 200-day moving average in small caps. Sectors like energies have helped prevent this absolute catastrophe scenario for small caps. Energies are a certain portion of this. Tech, very little energy exposure, but very little other geopolitical exposure to a certain extent other than the concern over growth risks. Now, higher interest rates, that's a problem for growth stocks. Higher interest rates are also a problem for small caps. Higher interest rates can be a problem for every company, particularly when we're seeing things that can harm economic growth. And we are seeing the VIX near 30. Now, the VIX to me is not high enough. Given current market conditions, we got the VIX to 35 2 weeks ago in a less bearish setup. More panic 2 weeks ago than we see today. See a lot of put sellers on this market right now, perhaps taking profits on hedges or closing out both hedges and long stock positions. So if the market's moving to cash, there's less need to hedge, less panic buying of puts. Um, but it also means that the market's less protected to the downside for the longs that are still there. And if the bear wants to gain control, they may have an opportunity here to start buying extra excess puts, really putting some pressure on the market if it starts to fall. This may be considered a bullish indication, the fact that the VIX isn't spiking, but to me, it also indicates the positioning. And more so than anything, if the positioning is not that long, it doesn't mean the market can't go down, but it means that the liquidation side of things may be done. And now it's about whether or not the bear wants to actually start to position more aggressively on the short side. Now, this week we didn't have a paid trade. I looked at all the signals this week and I was worried about the market. And I thought that with the market weakness coming into Tuesday and Wednesday in particular, more so Wednesday than Tuesday, that a lot of things could turn negative. And a lot of things did turn negative, but the signals that we were looking at on the AI from the bull case actually held up very well with most of the trades that the AI was signaling bullish actually finishing up on the week. We had some names within energies, fertilizer companies, etc., that were actually bullish. And so while it meant that we held off on the trades this week, that ended up being just fine, if not good, generally good actually. It increased the confidence for the trades for next week. So I'm going to be looking at a lot of these trades this upcoming week, expecting to add a trade or two or three, depending upon how the market conditions are going and how dynamic the fundamental inputs are shifting. Live trading performance has still been solid. We've had some good ideas with the earnings announcements, as well as utilizing some of these other AI signals that maybe didn't initially look like they would have fit with the paid system. Make sure you're joining us, Vlad and I, morning bell, closing bell. We got the morning bell from 9:15 Eastern till 10:15, 10:30 Eastern, about an hour. Closing bell from 3 to 4 Eastern time, last hour of the trading day. We're always happy to talk through other stocks and look through some of these AI signals. There's a lot of them out there that can be very good. I will note that Friday we had no bullish signals, and Friday was actually a very bearish day in the market, so a good day not to have any signals. But we do have signals already for Monday morning, and we'll be talking through those as well as many other ideas that are out there that may be on deck for the AI as the technicals look very interesting. You can always email us as well. I'm Keith at yellowtunnel.com and Vlad is Vlad at yellowtunnel.com. Happy to answer any questions. And, we're again looking forward to a very interesting week from the fundamental side of things and see how the market reacts to this news as it unwinds. Thanks again, everyone.